Tesla shares sinking this morning. After missing street estimates for its first quarter delivery, the stock has been punished so far this year, down over 30%. Tesla, along with Apple, have lagged the broader market so far this year. Meanwhile, the S&P 500 has notched several new record highs as tech begins to lose some of its luster. What sectors can investors look to for growth? Now, Citi may just point you toward consumer discretionary. The firm downgraded the tech sector to market weight from overweight, and while boosting its rating on the consumer discretionary sector to overweight. Joining us now is one of the analysts behind the call, Scott Chronert, Citi U.S. equity strategist. And Scott, thank you for joining us here today. This is a call on consumer discretionary. You are excited about the auto industry, the automotive industry. Just explain your call for us.
Well, let's put it this way. We've been underweight the autos for the better part of the last quarter, and we decided to lift it from an underweight to a market weight. What that did mechanically was play into other areas of the consumer, particularly retail, durables, where we have already been constructive, and we've even lifted our consumer services bias a bit more favorably as well. So all told, what that does is take our consumer discretionary view to a much more constructive one. But you know, it's really quite interesting because it's a related topic du jour, is that part of where we're going with our sector calls is the market's evolving. Market's evolving away from the tech and cyclical leadership that we've had since early November. We think we're starting to see signs that the market is gradually positioning in favor of those parts of the market that should, at the margin, benefit from an eventual Fed pivot. Consumers front and center on that.
Well, talk to me then about what that potential Fed pivot could be doing to equities. We're seeing a lot of red on the screen this week because of some hotter than anticipated data, particularly with the ISM on Monday. Has that changed your view on the ability of equities to withstand a higher for longer environment?
You know, it hasn't from a structural perspective. I just think what we have to keep perspective on is that this move, this aggressive S&P move, since early November really has been predicated on soft landing expectations and almost a Goldilocks persona to what's been going on regarding the economy and the Fed. So when you get incremental data points that question the timing of that first Fed rate cut, and we're still in print thinking it's sort of a June time frame, that's going to distort and bring into question that Goldilocks soft landing, which is, in our view, a reason for the market to, let's call it, digest some of the gains that we've had. So it all sort of fits that way, Madison. But what I would say is that we still think, on balance, the way the data is unfolding here is that the Fed, we think, is going to have a decent underpinning to gradually lessen its degree of restrictiveness.
And if you could keep your macro hat on for a second here, I want to talk to you about the labor market. We just got a JOLTS print. I don't need you to weigh in on expectations for the report in particular, but maybe tie into the labor market how you're viewing the consumer discretionary sector and maybe even the tech sector that is a little bit less out of favor right now with you.
Yeah, so tech sector from our view, let's cover that one real quickly. We think what's happened with a lot of this run, number one, we'd argue that Mag 7, we call it the Big 7, has really become much more idiosyncratic in its behavior, and that's been underway for several months now. As it pertains to the labor market, we get it. The Fed is very clearly focused on that as an indication of where the inflation circumstance is going. We still think in aggregate the inflation trend is one of decelerating. Getting from 3% inflation to 2%, that last mile, if you will, is going to be a little bit more difficult. It's going to take some time, but we think the trends are in place for that. Coming back to how this all fits into this broader narrative, the market's anticipatory, right? And when you do go down a path where you see that Fed pivot, when you go from a couple of years of a Fed hawkish narrative to something that's different than that, you need to begin to stay one step ahead of where you think that sentiment shift is going to go. We think in aggregate that the consumer, yes, while we're feeling this employment issue right now, gradually is the cutting edge of who should benefit at the margin from an inflection in interest rates, particularly at the short end.
I want to tie the macro picture to what we're seeing in some of the valuations, because you rightfully mentioned the valuation elephant in the room a couple of times in your recent note. So I'm curious, to what extent could a eventual Fed pivot start to weigh on some of these hyper valuations that we've seen? And would that be a good thing for equities?
Yeah, really good question, Madison. So what I'd keep in mind here, and we've talked about this in the past, is that you have to remember, when you look at periods where the Fed is actually easing, you actually see volatility increase during periods of Fed dovishness, much more so than Fed hawkishness. Doesn't intuitively make sense, but what's really going on is that the Fed is responding to some form of economic or macro angst. That's what's driving the change or inflection in interest rates. So when you pull this together, what we think happens here is we're going to be entering a noisy period. The data that we're talking about today is evidence of that. And in that noisiness, what it brings us back to is, hey, we've got a market that's trading at nearly 23 times trailing. Our fair value model, the high end of our fair value model for the S&P is just over 20 times. So what's happened with this move since November is that, in our view, prices have run well ahead of the fundamentals. Now, we're bullish on S&P 500 fundamentals, but we think we need to allow some time for those to grow into the price action. At the end of the day, when we come back to this valuation question, to us, it's really, hey, look at, we do think that the equity markets are due for a digestive phase here. It's why we haven't come off of our 5,100 year-end target for the S&P at this point, despite the run. And it's even, we're getting some flashing warning signs out of our lead sentiment indicator, the Lefkovich index, which we've discussed about over the past couple of days as well.
Yes, the Euphoria Index as well. We've covered that here, but we got to let you go. Really appreciate all of your insights here. Scott Chronert, Citi U.S. Equity Strategist.
Thanks, guys.